Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategist. Today, I'm thrilled to be joined by Todd Sohn. Todd is a managing director and technical strategist at the firm. We're going to talk all things markets. Todd, how are you doing today?
I'm great, Ross. Nice to speak with you as always.
Great to have you on again as well. I want to start with this rally in the market. You know, it's been impressive, but there's also a sense that it's been big tech and basically nothing else. You all had a table out this morning in a note that kind of confirmed that. But what do you make of this fairly narrow rally, and does it mean anything for how you all look out to the future for the broader market?
Yeah, it's a great question. It's a very popular question amongst all of our clients. And just to add some context, the five largest stocks in the S&P 500 are about 24% of the index now. That's the highest we have in about 4 decades of data. And just to look within that, you now have two stocks, Apple and Microsoft, that are each over 7% weights within the S&P 500. It was rare to get one name over 7%. Now we have two weights at over 7%. So there is this mega cap influence going on within the indices. And I would just say that's how market cap weighted indices work, right? When the biggest names go up the most, their influence is always going to increase. And I get it can create anxiety, especially for active players, because it's very difficult to outperform. And it's also created this narrowness phenomenon where really the most important chart going forward is the equal weighted S&P 500. That puts Apple and Microsoft on the same playing field as some of the smaller names from, say, materials or real estate. And that's lagged behind here. It has not broken down, right? That's important. It's well off the October lows. But going forward, we need to see the equally weighted S&P start to pick up the pace here. It doesn't have to outperform. In fact, the equally weighted S&P underperformed throughout much of the 90s and much of the 2015 to 2020 cycle. But it's important that there's that participation there. And so if that starts to continue to diverge from, say, the NASDAQ 100, that's going to create a durability issue and likely start to impact the market into the back half of the year. So again, keep an eye on the equal weighted S&P, ticker RSP, that's the ETF. As long as that starts to go up, we'll be in all right shape. But for now, it definitely remains a point of anxiety and consternation for all of our clients.
Yeah, absolutely. A point of anxiety for those worried about breadth, and a point of, you know, for those in the space or excited about the space, a point of euphoria and a sentiment, you know, positive sentiment we haven't really seen in a couple of years. You all do a lot of work on sentiment and positioning based on how people are voting with their dollars. So what kind of funds are they putting their money into, and what does that say about investor sentiment? What are you seeing on that front right now, given that dynamic you just described?
It's strange because tech flows really are not reflecting the frenzy or the mania that you'd think would be accompanying this move. You've had outflows from the NASDAQ 100, QQQ. You've have inflows into the cheaper version, QQQM, but that basically ties out to zero. You've had outflows from the spider tech sector products. You've had inflows into leveraged inverse tech products, so bets against the sector. I think that's helpful and supportive towards the tech sector. And broadly speaking, equity ETF flows remain very restrained. In fact, all the attention's on money market funds. We look at the money market data every week, and the flows and assets that are going towards those funds, because you're getting 5% now in this challenging environment, are very aggressive. I think that's all what everyone is focused on. And in a way, once equities get to a more attractive level, perhaps, I suspect that some of that money market money will come back into the equity market. So I would mark flows as very, very supportive, given where we are almost 8 months off the low, and particularly amongst the tech sector. It's just very strange that there's just not adapting what we're seeing from those mega cap names. Again, it's very, very restrained and broadly speaking, very supportive.
That's fascinating. I would not have expected that, quite frankly. But let's step away from the tech sector for a final question and look at the rest of the market. You mentioned the equal weight index is lagging, but either domestically or internationally or both, is there another slice of the market that you like, or a stat that's acting supportive of the broad market, you know, to kind of diverge away from this tech dominance for a minute?
Yeah, so I'll give you a stat. At the end of April, I know it's early June now, but at the end of April, the S&P 500 broke a year-long streak of having negative year-over-year returns. Right, a year-long streak. That is very rare historically to get 12 consecutive months of bad year-over-year performance. And so we went back historically, And the following year, when you do break this streak, as we did in April, you are up over the next 12 months every single time. Now, the returns are very, there's a wide variance. You're up 2% to 38%. But at the very least, it would suggest that maybe the worst is behind us here from what we saw last year. So I do think that's an optimistic statistic that we should all keep in mind. Yes, it can occur in challenging environments like the 1970s, but if you're looking for something that has a good hit rate, that would be the stat. Now, if you wanted to diversify away from the tech-heavy S&P 500, I would consider Japan. The valuations are attractive, and what we like about that from a technical standpoint is that trends are very strong. Some 70 to 75% of Japan stocks are trading in an uptrend right now. It's actually one of the stronger markets globally. And we can always go back to the case that it's a market that hasn't made any money in 30 years. So another optimistic scenario would be, okay, maybe this is finally the time where Japanese equities start to work. And ideally, if they do have to raise rates there, because they've had yield curve controls, that a lot of the money would come back home and perhaps boost the equity prices there. And what I also would note is that it's a very balanced index, right? It's not tech heavy, it's not financials heavy, it's very much across the board, even amongst the major sectors. So if you're looking for international diversification, take a look at Japan.
Awesome. Todd, really, really good stuff. Thank you so much for the time. I appreciate it as always, and hope to talk to you again soon.
You too, Ross. Thanks a lot.